Hey everybody, welcome to Monday morning, 9 a.m. It is me, Gareth Soloway, ready to rock and roll with you, set the table for the week in action and give you chart setups, swing trade levels, day trade levels, and we're going to touch on some macro. We have actually, interestingly enough, some big things going on in the market today. So I want to first dive in with what I'm going to call Macro Monday, and we're going to look at some various macro charts that kind of put a good framework on everything that's going in. Now remember, last week we saw some interesting action. My biggest takeaway was that semiconductors started to stutter. We started to see stocks like Nvidia roll over. We'll take a look at that chart. Where is the target on that? Because it actually is getting close to a potential bounce level. Now, bounces do not mean long-term investments. Make sure you understand that. But bounces can be very lucrative if you buy at the right technical support and you don't get too greedy. So what we're going to do is we're going to jump over to this chart right over here. This is the dollar yen. But before we get into the dollar yen, I actually do want to go over some of these charts. So this is the first chart I wanted to show you guys today. This is US CPI year over year in orange from 2013 to 2023, so basically the last 10 years. This blue line is CPI year over year from 1966 to 82. And the reason why I want to look at this is because it talks a little bit about what we could see in the future. If we are replicating the inflation from the 70s and 80s, then this could be our future. And what we see here is that both lines track each other. So the 2013 over the last 10 years in orange tracks almost identically the 1966 trend line here, which is the CPI for those years in basically the 66 to 76 area. Now, what's interesting here is look at the pop, look at the drop, and then look at where we see inflation continuing into the late 70s, into the 80s before it collapses down into 82. And the reason why I bring this to your attention is because everyone is so 100% sure that inflation is going back in this box. You know, even with CPI data recently upticking a little bit, we saw PPI data upticking a little bit. Everyone is still saying, hey, listen, we're convinced it's going to go back to 2%. The Fed will be able to cut rates very easily next year. There's going to be no issues whatsoever. If this tracks, and again, you can't deny the relative nature of both trend lines tracking, then what we're going to see is we're going to see inflation come down a little bit more and then start to pop again. And what's fascinating about this is this could tell us the future of the stock market and the economy. Think about this. Imagine if we see the economy stutter late this year into next year. Inflation's at around 2.5 to 3%, which would be right down in this area relative to where we are now. Now, the economy starts to struggle. Unemployment starts to go up. What happens if the Fed has to lower interest rates when we're at 2.5 to 3% on the inflation rate, right, or the CPI rate? Imagine what that triggers. Could it trigger this next wave to the upside in inflation that takes us even above the previous pivot high? So the previous pivot high for us, we know, was around 9%. What we're curious here is, does something in the economy, does a black swan event, does the economy just start to stall out because of the lag in interest rate policies that then causes this to jack up before eventually it comes crashing down? So that was one of the things I wanted to show you guys real quick. This is another interesting one. This goes more into the banking sector. And just looking at this commercial real estate loans by bank size. And what's scary about this, folks, is that we know that the big banks, right, the JP Morgans, the Citigroups, the Bank of Americas, they actually have relatively lower exposure to commercial real estate. But it's the small banks, this is the trouble. And what we already saw with Silicon Valley Bank failing and some of these other banks, that they, again, even though it wasn't necessarily the reason those banks failed at this point, these smaller regional banks had absolutely an insane $1.9 trillion in commercial loans. And we know that the commercial real estate is already in tatters, essentially. So this is going to be a lot of dead weight on the small banks. And what I would say is you have to expect more bank failures over the next basically 1 to 2 years. This is all going to implode. Now, interestingly enough, this sets us up where the big banks are going to be fine. All right, I don't think the big banks have any trouble here. The negative for us as citizens is that what this is going to do is it's going to consolidate power from the small banks, that gives us diversification, that makes it a non-monopolistic situation in the banking sector, it basically is going to mean these banks up here start to go away, and you see more and more wealth in the large banks. I mean, they're already too big to fail. They're going to basically become mega players that are not only too big to fail, but they could probably call the shots at that point because the economy will be totally based on their survival. All right, so I think that's an interesting thing, right? We always talk about how things could change, and ultimately we're going to see more and more of the small banks go away and consolidate into big banks. That chart right there just told us everything about it. Next chart I wanted to show you guys, S&P 500, cheap or expensive. Here's a ton of metrics: trailing PE, trailing gap PE, forward consensus PE, Shiller PE, EV to EBITDA, trailing PE. I mean, these are all the ways that you make valuation metrics in the stock market right now. And what we could see over here, folks, is that if you look at how many are above valuation, like longer term trends, there's only one metric out of all of these that tells you that the markets are not insanely overvalued where they are based on all of these metrics. And we're talking 2, 4, 6, 8, 10, 12, 14, basically 20 valuation factors. Out of all of that, one tells us that the market is not overpriced. Everything else tells us to be extremely careful. And you're even going back, it tells you the history of this. So again, I'm just throwing it out there. My information is for you to kind of take in, digest. You do what you want with it. Maybe it doesn't change your mind. Maybe you still want to be all along the markets. But I do urge caution as we head towards what I view as being a very problematic period. This is another one for a bigger economy. This is the economy look. This is the debt to income ratio for all home buyers. And this is the problem with it, right? So I think I told you in one of the past streams how we're now spending about 40% on housing of our income in general. If you looked at everyone out there, 40% goes to housing. The problem with this is, and why, I mean, that's obviously a crazy number, but look at what the peak was at the housing bubble top here, 39.1%. So we're actually now above that on a debt to income ratio, above where we were in 2006 going into 2007 and the financial recession, the housing collapse. So again, just makes you think, is now the right time to buy a house, or do you want to wait a few years? Although not that rents are that cheap, of course. So I mean, there is some give and take. But as a homeowner, I will tell you this, I don't think that when people say it's better to put money into a mortgage to pay and eventually own a home, I actually think there's faultiness to that, and I'm going to tell you why. I own a home, and the mortgage payment is probably one of the least expensive parts of owning a house. It's all the things that you have to fix. The roof needs to be replaced. This window needs to be replaced. It's, this pipe broke, whatever it is. Those are so many other costs, including real estate taxes, all of these things that a lot of people won't tell you about when you're thinking about owning a home. Owning a home is not cheap. In fact, when it's just rent and that's all you have to think about, and you say, hey, listen, if something breaks, I call the landlord and they come and take care of it, it makes life a lot easier. There's also a give and take there. What's your time worth? How much does it take for you to go out and call someone and wait for them to come and have them fix it, or fix it yourself versus just paying flat rent? And so again, it's a give and take. I'm a homeowner, yes, I have rented many times in the past, and I will say again, comparing the two, life was a lot easier and in a way simpler and cheaper when I was a renter, even at these crazy levels. All right, last thing I want to show you guys here as we finish up on Macro Monday is the Treasury yield spread 10 to 3 months, 10-year to 3 months. What I want to show you here, and this is a major fallacy for a lot of people, is that they think, oh man, the inversion of the yield curve, why isn't the economy going into recession? If you look historically, these grayed out kind of areas are your recessions, right? Going all the way back to the 80s. The actual recession does not really start until the uninversion of the yield curve. And so if you look at what we've been going through right now, we're actually no different. We're no different at all. We're not in a recession right now, but we still have an inverted yield curve. And what we could see again is that the uninversion occurs here, and then once we're up here, that's where you're going to start to get, right here, the uninversion, that's where you're going to start to get your recession. So again, just kind of some food for thought here on this day. And again, I think it's just worth kind of keeping an eye on. I do want to jump over to this screen, guys. I want to take a look over here. So we're going to jump right over here. I want to look at oil, all right? Let's look at U.S. oil because U.S. oil has moved up pretty significantly. And I want to show you a couple charts on this front, right? So if we go to the daily on oil, it's starting to break down a little bit, right? So this is your daily chart. So we've had this amazing move up. This candle formation right here is of interest, all right, because it's a reversal candle. Now, reversal candles are not as good as engulfing. To make an engulfing candle, and by the way, I would say in terms of holy grail candles, reversal engulfing candles are the holy grail. All right, now a reversal candle is good, but it's not a reversal engulfing candle. This is a reversal candle. See how you basically reversed the previous day? It was a big green and a big red down. Now, if you want to see what a reversal engulfing candle is, let's bring up a chart here. Let me see if I can remember which one it was on here. I think it was on the NASDAQ. Let's look at that. The NASDAQ 100 here. Okay, so actually the QQQ. Let's look at the Qs. I think it was the Qs, or maybe it was the S&P here. There it is. There it is. Okay. So, and again, I'm trying to give you guys perspective so you can learn a little bit here. But basically, see how you had green, 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 and you opened above any of these past candles, and you closed below all of these candles. That's a reversal engulfing candle. That is the holy grail for sell signals when it comes at a top. Now notice you also had this beautiful channel and it was right at the top of that channel. So that's like finding gold and then also finding, you know, platinum and everything else like in a chart. It's just amazing. But look at what the market's done since then. And we're actually trading down a little bit today again, but that's a reversal engulfing candle. So you want to be aware of that. But going back to oil, again, there's a couple situations here. So we are seeing oil starting to roll over just a little bit. The bigger question I have is, again, what do we ultimately come out to form here? So we do have resistance. There's a little bit of resistance right in this vicinity, and that, again, can be potential resistance. Let me just draw that trend line right there. So you have two trend lines, right, from this pivot right across, and then this lower pivot, and we're right into that area of resistance. So it makes a lot of sense because you go back here. What I love to do, by the way, is go to a larger time frame, right? If we go to a larger time frame on this chart and zoom out, you want to get a bigger picture. So if oil breaks above this area, is it going here? Where's it going? And this is how you have to analyze charts. You want to start looking at trend lines, and you want to take this trend line and dropping it down here. So that would be an intriguing area. If we ever got back to 120, I would be looking to short it. On the underbelly of oil, you'd actually look at this lower level right down here. This would be a fantastic level if we get down to this area. Not that we necessarily will, but it certainly does look interesting there. All right, so I want to go over a couple other things. Dollar yen. We got to look at the dollar yen, guys, because it is breaking out. The dollar yen is significant because it does play into cross-country carry trade type stuff. And I showed you guys this chart last week, right? And basically what we have here is if we put a trend line right at this top, look at that. Look at the breakup above that line. So this now is a flashing yellow light. Now I wouldn't call it a red light yet, but it has to be putting you on alert that there could be some issues going on with Japan over the next 1 to 2 to 3 trading days that we have to watch out for. Because remember, recently we saw the yen carry, the yield curve control from the Japanese central bank be loosened. Then they had to actually go in and buy bonds to kind of keep it from spiking up because they have an inflation issue right now. But watch that. Where's it going to go? I'm going to show you right now, folks. Take a look at this. So if we continue up on this, what you're looking at is us going back to basically 150 USD JPY. So that is your next target, and I think it's important to recognize that if we get back up there and we look, when the dollar yen was up here, right? When the dollar yen was up here, that's when the market bottomed in October. So as soon as the yen began, or the dollar yen began to decline, that helped the stock market rally, which is the rally we have still been in since October of 2022, almost a year ago. So the idea here is this. If the dollar yen's breaking out and it's going back there, likely there will be a trigger, something to do with what's going on here, that's going to send the stock market lower. Okay? Now, I do want to talk about the 10-year yield as well. We got to look at the 10-year because the 10-year is also now on the verge of breaking out. It already broke out from this downsloping trend line. We've now moved above this high, and we're now approaching, after a small pullback, basically 4.2% on the 10-year. Now, based on analysis, you want to know where this thing's going? Very simple. Take this high here, connect it to that high, connect it to that high, and that's going to give you your target range. All right, so Look at that. That's your target right up here. You're looking at right around 4.3%. Interestingly enough, if we take this high over here and stretch that trend line out, look at those two lines converging right at that spot. That is your short-term upside target on the 10-year yield. Now again, is rising yields a positive for the stock market or a negative? And the answer is it's a negative, because the higher yields go, especially long-end yields like the 10-year, the 20-year, the 30-year, not only does it put pressure on people borrowing money, but it also gives people a reason to move out of stocks because the longer-term yields will be guaranteed money. Right? So if you go in the stock market, yeah, you could make 20% upside, 30% upside, but you know what? You could lose. At these levels, you could lose 20 to 30%. You go in and you get a 10-year, you get a treasury at 5%, you're guaranteed 5%, which by the way, right now is above inflation by a decent margin. So again, there's this give and take with the treasury market where the higher yields go, the more people get convinced to move out of stocks because of the risk, especially if we get more chatter on a recession, into the bond market. Okay, so that's one of the things I wanted to go over. I want to jump back to this chart here, which has the dollar yen up here. But basically, one of the things I wanted to go over here is I want to look at some of these oil stocks real quick. MPC, this is one of my favorites here, guys. Again, if oil is going to start to pull back, look at this chart here. Absolutely amazing channel. And again, I think I highlighted this last week, but it just on Friday tagged the high end of that channel. It also is touching the $150 even number. To me, way short-term extended. The RSI's probably near 90 at this point. You should expect a check back. Now, where's the logical place for this to pull back? Because again, you know, some people go into trades and they're like, oh, I'm going to hold it till it hits this. And I'm like, okay, that's great, but what's the thought process? What's your thesis for doing that? And the answer is you always want to look at the chart. So on a pullback, here's your target. Very simple, right? If you start pulling back, there's nothing in this range on the chart, but as soon as you get here and here, now you have something right there. So you're looking at a 135, 136 pullback. Now from 150 bucks, that's actually not bad. It's almost 10%. But this is where swing traders thrive, guys. It's in this choppy market environment where people are getting whipped in and out. And we as swing traders, we just nibble here, we take some profits. We nibble there, we take some profits, and we do it in the right way. All right, couple other charts out there. I did want to look at ExxonMobil here. Take a look at Exxon too, because look at this, right? So you now have multiple trend lines. I'm going to actually go to my weekly chart that come from major levels, right? So here's a trend line, and you can see why ExxonMobil bottomed. Pivot low or pivot high to pivot low gave us this low. Pivot low to pivot low to pivot low gave us the same low. When you have two intersecting or connected trend lines from two different spots, that's like, again, we talked about Holy Grail with the engulfing reversal candle. That's essentially the same thing. The probabilities, and everything I do in trading is probability based, is that ultimately that's telling you something. That's telling you the probabilities are extra high of a bounce. And look at what Exxon's done, right? This is the weekly chart. So now it's had 4 up weeks in a row. Now, again, if it comes up to this level, that's going to be a major resistance level, and that could be your shortable level. That looks like it's right around 115 to 120 in that upper range. All right, I do want to cover Bitcoin and crypto real quick. Here's your weekly chart. Let's go to your daily chart. Crypto, again, as dead as can be, but it's still in this range. And the key to Bitcoin, guys, is that here's your resistance, here's your support. If the support breaks, watch out. Then things get very messy very quickly. If this area breaks and we stay above it, and again, this here it broke and it reversed. So you really want to see a couple days above it. If that happens, this thing's off to the races. Bitcoin volume right now is so low that I do worry that it's setting up for a huge move. The volatility and disinterest in crypto right now, especially Bitcoin with the lack of volatility, is massive right now. Just people not caring. Such tiny volume. What that does is it makes vulnerable very big swings in charts. So be ready that if you do crack this, there's going to be a lot of stops and a lot of people shorting, and it could flush. I mean, you could flush literally, you could dump here and you could go to 25,000 in a split second, right through it. That would not surprise me. On the upside, by the way, if you break out, you could go to 30, 35, 36,000 very, very quickly. All right. Gold, guys, gold continues to move back here. We are down ticking on gold. Little bit of consolidation here. The key for me is this trend line. This is that longer term trend line I've been talking about, folks. So again, we want to continue to follow that one. Beautiful down sloping trend line. We hit it here, bounced. If we come back in, it's right around 1880, 1875. This is an area of support. I have been accumulating gold now ever since we've been kind of consolidating back down here a little bit. I likely will accumulate more today because I do think that, again, as things get later in the year, you're going to get a big move on gold and a breakout on gold. So watch for that very, very carefully. I did say I would look at NVIDIA, guys. NVIDIA is trading down this morning. There is a target level for a potential bounce today for me as a trader. All right, so we're basically looking at there's a gap fill at 395. This gap fill right here and all this sideways chop, 395. And you also have this channel line right down here. NVIDIA has been crashing hard these few days. If it gets below basically 395 and you get down to maybe 390 area here, so 390 to 395, that, my friends, looks to be a quick bounce level. So I will be having that on my radar for today. I will be trading live through the intraday live trading room at inthemoneystocks.com. And again, that chart looks very, very intriguing. Semiconductors, by the way, they've really lost their luster. All right, let me bring it back here, guys. All right, so there's a lot to cover. Honestly, I wish I had another 30 minutes with you guys because there's even more charts that I wanted to bring to your attention. But I will say this. This week, we have some decent data, retail sales, FOMC minutes. These are all things that we have to watch for. Ultimately, watch the dollar yen, watch the US dollar, watch the 10-year yield. Those, to me, are the most important here for the stock market. We're getting to a pivotal level on the S&P 500. In fact, I want to show the SPY one time here, right? We'll jump back to this camera right over here. All right, the S&P 500 is getting very, very close to some key levels here. And I do believe that if we break some of these key levels to the downside, we are going much, much lower. And I just want to show you guys this right here, right? So here, this is where we are. Look at this. Pivot low, pivot low, pivot low, and we're kissing it. If we get below this, you're vulnerable all the way down to here on the S&P 500. Okay, now let's flip back here. My point is this. We are entering a tricky period in the markets here. We're already seeing it. It's not as easy to just close your eyes and go long. Be careful out there. I'm going to continue to tell you what mainstream media is not telling you, showing you the economic charts that they're not showing you. I want you guys to be up on point. And by the way, there's plenty of longs out there. There's plenty of bull markets, but you also have to be aware that bull markets don't last forever. It's been a great run since October of 2022. I'm sending the signal out there to be cautious, be careful, learn, take it into account, but make your own decisions, guys. That's all I ask. Learn everything, get all the info, make your own decisions. This has been the game plan. I'll be back tomorrow, 9 a.m. Eastern Time with more information. You guys take care.
Let's go.
Hey, thank you.